And I want to show you what happens or what the difference is between this and our theta positive trades. As you can see, the theta is quite negative. In fact, it's a negative 76. That means for each day that you hold this particular trade, you're going to lose $76 out of this position. That's not a good place to be in, really. We'll increase the date again and see how this position differs from the one that I just showed you with the SPY, in which we were theta positive. As we increase the date, you can see that the losses, if the stock does not move, increase at the rate of approximately $79, and in fact the theta itself increases on a daily basis. And if the price doesn't move, the losses mount rather quickly. That is the danger of buying straddles or strangles on any particular stock. Just a little over 10 days or so here, we've already lost $1,405 on the straddle, which cost us $3,600 in margin. So let's see what we can do in order to help not only make a profit, but to counteract the decline of the option premiums and the decay that takes place before expiration. As you can see, our gamma is 182. That's the rate at which the delta will change. Even at the current position, even though we bought the at the money straddle, we currently have a delta of a minus 130. The idea with gamma scalping is to constantly either purchase or sell stock, not options. We want the underlying stock to bring us to a delta neutral position. You're probably feeling a little bit lost at this point, but I would encourage you to keep on with this and try to understand exactly what we're going to be doing. The purchase and sale of stock, both buying and selling on a regular basis throughout the day, if possible, will help generate and lock in profits that we can get from the stock. All the while we are protected from any losses on our buying and selling activities by our underlying straddle. The only danger in this position is having or selecting a stock or an ETF or index that does not move for an extended period of time. Because as we've seen, if the stock stays relatively stable, we have absolutely no opportunity to buy and sell the underlying security. And that will cause theta to create and mount a larger amount of losses on a daily basis in our position. The goal then is to have the price move enough so that we can trade the stock to offset the decay of the theta. In fact, have it move enough so that we can also generate a profit on top of the theta decay. The reason this gamma scalping methodology, this strategy works, is because the deltas of the position change as the stock moves. For example, if we were to do the gamma scalping on the IWM, we currently have a negative delta. In order for us to get to a delta neutral position, even though we have the current at the money straddle, we would have to purchase stock in order to get to a delta neutral position, and that's the goal. In fact, we'd have to purchase 130 shares of stock to be at a delta neutral position. Let's go back and see exactly what happens. If we purchased 100 shares of stock, we would now bring the position to a relatively neutral delta position by buying the stock. Now what happens if the stock immediately rallies after we purchase the stock? Well, let's take a look. Let's adjust our price. Let's say it goes up at least $1. Now we are long 195 deltas. Well, in order to get back to a delta neutral position, we would have to sell the 100 shares that we purchased at the price that we bought it at, which was at the time. Let me just check the prices. We purchased it at, and these bid and asks are quite wide. It's actually $7.11, which was the last trade. So let's adjust this to $70.11. That, the $70.11 would generate a profit if the current price was $71.35 of $120, because the difference between the price that we bought it at $70.11 and the current price is $71.35. The price went up, allowing us to generate a profit of $125. At that point, not only did we counteract the $78 in theta decay, but we made a $25 profit on the position. And if we can do this several times a day, you can see that the profits can be generated very, very quickly, as long as the stock continues to move. Okay, now let's take an example in which the stock declines. If our current price is $70.11, as you recall, we were negative 130 deltas. We go ahead and we purchase 100 shares. Now, you might be asking yourself, well, if our delta is a negative 130, don't we need to buy 130 shares to become delta neutral? And that's true. We do have to, we should in fact buy 130 shares to become exactly delta neutral. However, it's more cost effective to buy shares in round lots of 100. It's also easier to be filled. So we're going to continue to use 100 shares or 200 shares or 300 shares or as many shares as we need in order to become delta neutral. So now we've purchased our 100 shares to get relatively close to delta neutral. If we purchase 200 shares, that would make us slightly positive delta. Now, if you believe that there's an imminent chance of the stock moving up, it won't hurt you to be a little bit positive delta. So you can use positive delta as a trading mechanism or as a signal to help you profit even more if you believe the stock is going to move up. Of course, if it moves down, then that's a different story. But you can still be within 50 points of delta or 60 points and still be relatively delta neutral. But we're simply going to buy 100 shares of stock at $70.11, which is the current price.